Open-ended, that's how the Federal Reserve describes its decision to keep banks' cost of borrowing money at near zero, at least through the middle of 2015. Fed Chairman Ben Bernanke said the low rates would stay in place even as the economy strengthens.
I personally don't think that it's a panacea. I personally don't think that it's going to solve the problem, but I do think it has enough force to help nudge the economy in the right direction.
By committing indefinitely to buy up $40 billion a month in mortgage debt, the Fed is hoping to energize the still depressed American housing market.
Housing is usually a big part of a recovery process. We haven't had that nearly to the usual extent, and to the extent that we can support housing, I think that would be a very useful outcome.
The Fed also issued more optimistic projections for recovery, raising growth estimates to as much as 3% next year and lowering the jobless rate to under 7% by 2014. As the cost of borrowing gets closer to zero, so will the return investors collect by buying bonds. That makes the stock market a more attractive investment. So U.S. markets, already enjoying a 24% rise in value over the past year, hit a near 5-year high on Thursday. But Bernanke drew fire from Republican presidential challenger Mitt Romney's campaign. It said the move would only ignite inflation and do nothing to help growth. Romney has already pledged as president not to reappoint Bernanke when his term is up in 2014. Time enough to confirm whether the Fed's commitment to even cheaper money proves the right move. Tom Ackerman, Al Jazeera, Washington.